everyone. Thank you for joining us once again here at Seaford & Brew for our economic briefing. This week, we had a kind of a crazy week, busy week in some of the economic numbers that have come out, and more importantly, we had that Fed release from the Federal Reserve meeting on the 16th. This Wednesday, they came out and they gave us their update in terms of their process moving forward. Several things came out of that meeting, and we saw the market react pretty strongly. They started thinking or talking about the process of tapering that asset purchase program, of which they're purchasing that $120 billion in securities every month. And if you recall, that's $80 billion in Treasuries and $40 billion in mortgage-backed securities. They will continue to do that as we move forward, and they will begin to have that discussion in more detail and laying out that plan to taper down those asset purchases as we move into the next several meetings. However, we have to remember that that's just tapering the overall level of purchases, new purchases. They continue to have to reinvest that cash flow that's currently on their balance sheet and running off. So while they will be beginning that tapering program sometime in the future, their balance sheet will not decline. It's just going to slow down that pace of increase. But that comment kind of reacted within the market, and we saw that 10-year Treasury move up almost 10 basis points after that. Since then, we did see that 10-year Treasury move back down, and we'll look at some of those numbers in just a minute. Overall, we know that they did not move that Fed funds rate. It continues to be between that 0 and 25 basis points. But we did, with this release in June, we did get their updated projections. And let's take a look at those projections. Overall, if you recall, they look at the GDP numbers as well as unemployment, inflation on both the pure and the core level, and then that Fed funds dot plot. So let's take a zoom in here at the median values. And we can see that median value for GDP for 2021 at that 7%, up from their 6.5% projection back in March. They didn't move the 22 projection at 3.3%, and then we saw in the 23 increasing it just a bit by 0.2% to that 2.4%. So overall, we continue to see these estimates as the increase in the overall growth in 2021, which is expected, and then a start of a pull-off in that growth rate in the future periods. And overall, this would lean itself to the level of interest rates currently that we have as kind of being a normal level moving forward, and no real big prospect of a tremendous amount of growth that's going to push up that overall level of longer-term interest rates. In terms of unemployment, we can see they didn't change all that much. It was 4.5% in March, and they kept that at 4.5% for the end of 2021. For 2022, they decreased it a little bit from 3.9 to 3.8, and then getting back down to that 3.5% in 2023. And if you recall, that is the unemployment rate we were at prior to the pandemic. So this kind of matches up with their overall level of their Fed funds rate. In terms of inflation, they have recognized that increase in inflation for 2021, moving it up 100 basis points from 2.4% to 3.4%. But as they have said over and over again, they continue to look at this inflation as transitory. It's not going to stick around month over month over month, and they expect that to pull back off. And then we look in 22, and they have that inflation rate at that 2.1% and then 2.2% in 2023. So this kind of dictates overall where we see that level of Fed funds going. Core inflation, they increased to 3% from 2.2%, and then increased the 2022 inflation number for that core level to 2.1%, and then maintain that 2.1% in 2023. Now let's look at that dot plot. That dot plot has changed somewhat from what we saw in March because of the growth that we're seeing right now. And they're changing a little bit on that inflation. We can see for the rest of the year maintaining a 0 to 25 basis point Fed funds rate. For 22, we now have 7 individuals that suggest there should be at least one change, one 25 basis point bump in the Fed funds rate. And of that, we have 2 individuals there that say we need 2 25 basis point changes. So overall, we have that, but still the median level is at that 0 to 25 basis points. And then the bigger change, of course, out in 2023, recognizing additional need for increases in that Fed funds rate, and we have that at 0.6, which is representative of about 25 basis point bumps. So as far as this is concerned, in my mind, we continue to operate over the next 12 to 15, maybe 18 months at the 0 to 25 basis points. This, of course, is going to help the overall level of cost of funds for our institutions in maintaining and potentially lowering somewhat those overall levels for now. When we look at the advanced retail sales and services number put out by the St. Louis Fed, we can see the very volatile in May, up 22.1%, very large number, but we have a basis issue where we're looking at the year-over-year changes, and prior year we had very low levels of retail sales. So it's more important as we move forward during this period to look at those month-to-month changes. And we can see here that May 21, that month-to-month change from April is actually down by 2%. So as we're looking at the second quarter months, we have April up just 0.1%, and then May down 2%. That's an important figure when we consider that the 60% or 68% of the economy is built off of consumer spending. So this could weigh on that overall level of increase in GDP in the second quarter. I do, however, think we will be around where we were in the first quarter, maybe a little higher at this point. But when we look at this, this is kind of concerning as we lead into the summer, and we look at the advanced retail sales from the U.S. Census, and of course, year over year, very strong number, up 28% in total. But when we look month to month, we're down by 1.3%. And in a lot of the different categories, we see negative numbers over the month of month. Motor vehicle and parts dealers down 3.7%. We saw furniture and home furnishing stores down 2.1%. We saw electronics and appliance stores down 3.4%. We saw building materials and gardening equipment and supplies dealers down 5.9%. So we continue to see month over month these changes being negative. So as we move forward and we get into the June releases to see how those numbers have fared, it will be interesting to see if we continue this downward momentum in these retail sales numbers. If that was the case, and we do see these downward numbers, that might suggest that we're going to see a little bit of a pull off in that overall consumer spending and GDP. That being said, we know the inventories level came down in the first quarter, and that contributed to about 278 basis point detracting from that growth in GDP for the first quarter. So if we eliminate that, we might have a balance out with a reduction in the overall level of growth in consumer spending and an increase in that investment component of GDP. So that might balance it out. But we'll have to see when that gets released at the end of July for the second quarter GDP. Overall core inflation we know was very strong when we look at it, up above that 3.5% for the CPI index, and for the PCE up above that 3%. But again, like a broken record, we have a basis issue. You know, these prices are being compared year over year to a very low level from 2020 when the pandemic was at its highest. And that is the overall issue, and we have to work through this basis issue. As we move through the summer and into the fall, I think it won't be until the fall until we get really good information about the inflation situation. So we'll continue to keep an eye on inflation, but recognizing that we're not going to get true numbers on this inflation situation until the fall. Overall 10-year yield, as we said, reacted to the Fed release, and then it came back down. Right now we're at that 1.46% at noon on Friday. And interesting chart that I came across by the Guggenheim Investment, and they look at this random walk theory in terms of interest rates in a 10-year Treasury going back to 1985 and showing how this 10-year Treasury has moved within their model and in the two standard deviations of their model results. And notice just the continued downward momentum here, and this is where we are today. This was released back in February, so this has come down off this high, and they continue their model at this point, continue to show some downward momentum and showing that in January of 2022, that median value at negative 0.5%, I think that's a little aggressive. When we look at the two standard deviation realm on the high end, we can see that closer to 1%. That wouldn't be surprising to see that 10-year Treasury get down to that 1% once again. There is, of course, that possibility that we see that 10-year Treasury move up, but I think that probability of rates going up at this point with the information that we have is less than the probability of rates staying where they are and moving down. I don't think we're going to hit that 2% interest rate on the 10-year Treasury by the end of the year. That is my thought at this time. But overall, that's where we are here in the economy at this midpoint in June. We look forward to having a release of our economic briefing in July. Have a great day, everyone.